Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've joined us for the first time, a huge welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm good, Bryce. Very excited for this episode. Very excited for what is happening in markets. It seems like it's non-stop. We're going to unpack it all in this episode. Well, we're actually going to dive deep on the one topic that seems to be dominating everything else, which is AI.
Yes.
And talk about some of the picks and shovels plays outside of the big tech names.
Yep.
If you're thinking about that as an investment opportunity. We're going to answer a community question on cyclical stocks. And then finally, we're going to speak to expert investor and former AFL champion, Chris Judd.
Yeah.
He runs Cerity Macro Fund. We spoke to him last year and he spoke about how he was positioning his portfolio for the US election. Spoke about some of the things that Trump and JD Vance were talking about around crypto and bringing back US manufacturing and what that might lead to. Now the election's happened. Trump and Vance are in office, so we wanted to touch base and see where he was thinking. So a jam-packed episode of Equity Mates, as always. Let's get into the news.
News and markets.
So we want to start today's episode with a bit of a deep dive on the data center and AI infrastructure spend. A couple of weeks ago, I think it was the second day that Trump was in office, he got a couple of the leading tech CEOs from around the world into the Oval Office and announced a $500 billion investment into building data centers, effectively. What was it? With $100 million to be deployed.
No, $100
billion to be deployed immediately.
This year, yeah.
This year. Elon Musk then came out and said, no way. But anyway, that's another headline. We've seen Meta come out and say they're going to be investing $65 billion in building a data center so large that it would cover a significant part of Manhattan.
That's not the full 65, but 65 in 2025.
Yeah. Microsoft have committed $80 billion towards AI infrastructure as well. So it is absolutely the buzzword of the moment.
Yeah.
And we want to understand a little bit more about where this money's going, but then also what are the flow-on opportunities for investment beyond just the hard data centers?
We're all sort of trying to digest what DeepSeek means. And that for people who haven't listened to last week's episode of Equity Mates, we unpacked DeepSeek, the Chinese AI model, on the Thursday episode. And there are plenty of questions about what that means for the competitive large language models, the competitive AI companies, the Googles, the OpenAIs, and also the downstream effects of what it might mean for companies that are utilizing AI, Microsoft, Google again. But what is guaranteed, like what is locked in, is that more than $200 billion is going to be spent just by those three big players. Project Stargate, which is Oracle, OpenAI, and SoftBank, as you mentioned, and the UAE Investment Fund. They're going to spend $100 billion in 2025. Microsoft, Satya Nadella came out and said he's good for his $80 billion this year, so they're going to spend that this year. As you said, Meta's going to spend $65 billion this year. So it's like, there's so many questions around AI and whether value is going to be created and what it means. But what isn't a question is what is going to be spent this year on building AI infrastructure. So if we're thinking about investment opportunities and where value is going to be created, we know that hundreds of billions of dollars is going to be spent. And we can start to think about where that is going to go.
Love that you can sit there as a high-flying CEO and just say, I'm good for 80 billion.
Yeah, I know.
I'm good for it.
So this introduces the picks and shovels play. And for people who are newer to investing, the term picks and shovels really comes out of the gold rush where, you weren't guaranteed to make money prospecting for gold, but where you could make really good money is actually selling the picks and shovels.
Yeah.
And so that's now a term that's used in investing where it's like, don't invest in the thing itself that is getting all the hype. Invest in the picks and shovels play that is supplying the hype sector. Don't invest in the lithium industry. Invest in the mining services companies that will service the lithium industry is actually as close to a picks and shovels analogy as you could get. Because and so we wanted to sort of unpack where the picks and shovels plays might be here. And there are some pretty well discussed and obvious names that we don't want to hold on. We want to talk about some lesser known names. But like, if we just rattle through the most obvious ones.
Yeah.
I mean, it probably starts with Nvidia.
Nvidia, absolutely. Others we've had on the show, ASML, the makers of the machines that make the chips. You've got Samsung, you've got Taiwan Semiconductors, TSMC, AMD, Supermicro.
Yep.
Sort of the list goes on. The big players that you always see pop up when it comes to this space.
If people aren't familiar with some of those names, ASML make the machines that make the chips. Samsung and TSMC make the chips. Nvidia and AMD design the chips that get made and then supply them to the end customer. And Supermicro make the server racks on which the chips live and get cooled.
Yeah. Which for me is probably more picks and shovels than the 5 above them.
Okay.
Yeah, it's kind of like those 5 are always up there, but then you're kind of going that level down, which is the racks and the coolers and everything that kind of goes into it. It's not the hardcore data center. It's not the chips themselves.
Yeah. Now, we're going to rattle off a number of companies here, and the intention isn't to say these are buy, hold, or sells.
Yeah.
The intention is to talk about an interesting angle into investing in this space and then give some examples of companies that are sitting there. But the lists are by no means exhaustive because there's a lot of companies that are going to share in this hundreds of billions of dollars of investment that's going to happen this year. So really the bulk of the money to go and build data centers to manage the AI compute, the most obvious and where the most money will go is to the builders and operators of data centers.
Yeah. Yeah. So locally here in Australia, you've got Goodman Group. They've done incredibly well over the last 18 months or so.
I think they were up like 75% last year. And it's something... So Goodman Group are a property developer and they manage it. And if you drive around industrial areas in Australia, you'll see a lot of Goodman Group facilities and warehouses. And some stupid percentage of their pipeline of work is now building new data centers.
It's crazy.
Yeah.
A few other names in that space. You've got Digital Bridge, Digital Realty Trust, and American Tower. What I would be looking at is who is going to be contracted, for example, to build a Manhattan-sized data center
for Meta.
Yeah. That's the work that can be done because you're right. Someone's got to pour the concrete. Someone's got to build it. Someone's got to own and operate it. Yeah.
But look, that is the most obvious play, and a lot of that work is priced in. These aren't new names, I guess.
No.
And so then you can sort of say, okay, so the data centers need to be built and then they need to be filled. And so, we mentioned Supermicro earlier, but names like Supermicro, Nvidia, and AMD are the companies that are some of the more obvious names when it comes to filling data centers.
To add to that, Ren, there's, I guess, the more boring or legacy tech names that are players in this space, particularly for like rack servers. So you've got HP, Hewlett-Packard, Cisco, Huawei, Dell Technologies. So some of those companies that have been around for a while stand to benefit from these data centers being built.
Here's a prediction for you. I don't think Huawei is going to get a lot of the hundreds of billions of American AI infrastructure spend. But then you can even go a step beyond that and you can say, all right, well, like who are the suppliers of services to those companies. And so two names that I came across when I was looking at this, again, you need to look at them yourselves. But Onto Innovation, so they are suppliers to the semiconductor industry, and they do a lot of defect inspection and help the semiconductor companies with their manufacturing processes and lithography and the like. And so that's like a picks and shovels play to a picks and shovels play. But how about this one? Ultra Clean Holdings. Heard of that one?
No.
They essentially, amongst other things, do cleaning services, ultra high purity cleaning, because semiconductor, like the facilities in which you make them, need to be like incredibly clean. We're talking about chips that are, have components that are the size of a grain of sand. A speck of dust can ruin a semiconductor. And so a company like that then services the foundries and provides cleaning services and the like.
Wow.
Yeah.
For some reason, that stock, as I'm looking at it now, is up 10% after hours.
Must have known it was on the list. So we've sort of said the sheds need to be built, then they need to be filled.
Stuff needs to go in it.
Yeah.
Yeah.
And then from there, it's
we need to turn the lights on.
They need to, and the servers
and
on.
the servers.
And the cooling systems. And so that then leads to the whole world of energy.
Yeah.
And the first bucket is energy generators.
Yep.
And I think the picks and shovels play that got a lot of buzz last year was nuclear energy.
Yeah. In this space, Okla is one that is probably most front of mind. It's Sam Altman's nuclear energy company. Late last year as well, one of the big tech companies were going to fire up an existing nuclear power plant.
Yeah, Microsoft signed a deal with Constellation Energy to restart the 3 Mile Island nuclear reactor.
Yeah.
The site of America's most infamous nuclear meltdown or partial meltdown in the 1970s. But 3 Mile Island shut in like the late, it was like 2018, 2019, just for financial reasons. Just like wasn't making enough money, wasn't profitable, renewables were coming online. They just shut it. But 5 years later, Microsoft signed the deal to reopen it. It'll restart in like 2027, 2028. And Microsoft had basically said, we're going to buy all the energy you generate for, I think, a 20 or 30 year period to power our AI ambitions.
It's wild.
I think if you just take a step back, like just overall energy demand is going to be higher, is really the starting point.
Yeah. So a couple of big players outside of nuclear here in Australia. Obviously, you've got Origin, you've got AGL, and then there'd be equivalents over in the States where a lot of this power is going to be.
But like Pacific Gas and Electric, and like there's a bunch. But I mean, you've got to keep in mind, like for some of these companies, this AI spend is going to be like a meaningful percentage of their business going forward.
Yeah.
For others, it is going to be like a cherry on top.
Nice addition.
And if the cake is not baked,
split too far.
If the cake is not great, the cherry on top doesn't save it.
Yeah. If it's a shit company.
Yeah. If it's a shit, or if it's just like the unit economics of energy are really, if the unit economics of electricity generation are really difficult, this incremental demand from AI might help a little bit, but it won't fix some of the more fundamental problems.
Yeah.
Some of the more structural problems.
Yeah.
Anyway, I think there's probably more interesting energy plays. And for me, it's like who provides electrical services to the data centers, like who keeps them up and running. And I'm sure there's a bunch of American utilities players that service, these big customers. One that we came across over in the States is Quanta Services. They're one of the bigger players, and they provide, infrastructure and they like repairs, and they do work on the electrical grid and electrical connections for big customers. And so in terms of getting these big data centers online and then making sure that electrical infrastructure is maintained, like those are some of the players where you would imagine there'll be a big incremental increase in demand.
Big time. And finally, all the data centers need to be able to talk to each other and communicate. And so that's where, those network companies really come to play. So Equinix is one, Megaport is another. I'm sure there's some other big ones overseas, but
Definitely, yeah. Well, it's just like the technology to enable data centers to talk to each other is going to be more and more important as these giant customers require more and more compute from all around the world. Look, that's by no means an exhaustive list, but hopefully that kind of demonstrates some of the thinking in terms of, all right, well, there's a fire hose of money coming out one way, and how can we think about where it will go? So if you've got a picks and shovels play that you think is interesting, hit us up, equitymates.com/contact, or share it in the Facebook discussion group, because we'd love to hear how you're thinking about the investment opportunities that arise from this infrastructure spending.
Not to drag this out, but I've just gone down a rabbit hole here on the cooling systems, the cooling solutions.
Yeah, nice. Yeah.
And this kind of ties back to my 500 to 5,000.
Okay.
Because I've got 5 of them, all global, and they've all been pumped because of the deep seek news. They're all down plus 10% overnight. Yeah. So I think, like, from an opportunities point of view, take this moment to have a look at some of these picks and shovels, because it feels like it's now a sector-wide sell-off with definitely opportunity for to get in where there might be an overreaction.
Well, I mean, it's interesting. So Quanta Services down 18%.
There you go.
Yeah, after the deep seek. God, I'm going to keep getting that wrong. This might be an opportunity. It's still trading at like 55 PE, but
it's all relative compared to.
Well, yeah, exactly. But PE, if you're just looking at it on Google or something, is trailing 12 months.
Yeah.
And so if they double their profit next year, they halve their
exactly.
PE.
And it's like where its competitors are sitting as well.
Yeah.
Maybe. Anyway. Exciting times.
Exciting times. Well, look, let's take a quick breath here and then answer a question on cyclical stocks.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, friend. I've got a question.
Questions.
Answered.
We love getting questions from the Equity Mates community. We have one here from Will. Before we jump into it, there's a link in the show notes or the description if you're watching on YouTube where you can leave us a question either as a voice message or you can send it through in written form and we'll try and get it on the show. But Ren, let's hear this question that has come in from Will.
G'day Equity Mates, Will here from New Zealand. I've heard a few of your guests talk about cyclical stocks in some of your podcasts, and kind of curious, what is your definition of a cyclical stock, and whether or not you could give us maybe some examples and what would be the advantages of investing in such a thing. Cheers, guys. Hope you had a great summer and keep up the great work.
Love it. Thank you, Will. Certainly did have a great summer. Hope you had a great summer, and thank you so much for the question. A good question. So how about, Ren, we start off with not necessarily our definition of cyclical stocks, but the definition of cyclical stocks.
I'd be surprised if those two differ greatly. Cyclical stocks are stocks just that follow follow a cycle, but it is essentially what they are. They might follow an economic cycle.
Yep.
They might follow a technological development cycle, they might follow a capex cycle, they might follow a commodity price cycle. But what does that mean? It's that there's a underlying driver of the stock's performance which isn't related to the company itself.
Yeah.
And that moves up and down in a cycle. And that might be driven by supply and demand forces, it might be driven by other economic forces. But these cyclical stocks, their fortunes are really driven by something that is outside their control and is variable.
And then generally what you'll find is the price of these stocks follows the cycle.
Yeah.
So the underlying commodity, like let's use mining as an example because it's probably the most obvious. You look at iron ore, you look at lithium, they all move in cycles depending on the supply and demand of iron ore.
Yep.
If globally iron ore is in high demand, China's up and running, building apartments, then there's going to be huge demand for iron ore and the price of iron ore will go up. Then you'll see that the big miners here in Australia, BHP, Fortescue, Rio, their profits are going to go up, their revenue is going to go up because they can charge more. Well, they're not charged more, but they are getting more for digging iron ore out of the ground, and the price of their stock follows.
Yeah.
Subsequently, when China comes offline and the demand for iron ore craters, you'll find the price craters and the share price for the miners will follow that as well.
Yeah. And it doesn't even need to be something as explicit as China. It's just like, as the price rises, more and more mines will come online because their economics make sense. And then at some point, so many mines are online and the supply is so high that they reach an oversupply. And so then the price starts falling and some of these mines then need to come offline, and all of a sudden the price will then bottom out because the supply and demand is in equilibrium, and then actually supply is too low for demand, and then the price will tick up again. Yeah. And so that happens in the iron ore market, the oil market. Like, most commodities will follow a cycle. Yeah. But it's not just mining. The industry of the moment is semiconductors. And really, up until this recent Nvidia-led boom, semiconductors were seen as a cyclical stock. And that was really because there was a process of big capex investment, and sort of the new generation of semiconductors were developed. And then there was a selling part of the cycle where these stocks would make a lot of money because they would then be selling their new generation of semiconductors to the market. Everyone would be adopting them, implementing them in their phones and smart TVs and computers and the like. And then those profits would tail off and the company would enter its next development phase. And profits would be low as they're developing, the new technology, the cycle repeats. And so it doesn't just have to be driven by a commodity, but these cyclical stocks are driven by something that sees their profits be variable and move in a cycle.
Like consumer discretionary is one as well, very much tied to economic activity. If everyone is experiencing pay rises and GDP growth and the economy is booming, we're all out there probably spending more than we usually would and buying discretionary items. Whereas if we're in recession and the economy is struggling, we're all pulling back and only spending on what we need to. Then those companies that are selling discretionary products kind of follow that economic cycle.
Yeah. So that's what they are. How to play them as investors? There's a couple of things. First of all, you can either try and time the cycle and buy at like cyclical lows and then try and sell at cyclical highs, or you need to find companies that can grow through the cycle. And like the big Australian BHP is a classic example of that. Like, it is a cyclical stock, but for Australians that have held it for 40 or 50 years, they've done very well because BHP has been a structural winner. It's grown through the cycle and it's managed the cycle well. You want to find management teams that are aware they're in a cyclical industry and invest accordingly.
Yeah.
I think the big watch out for cyclical stocks is you want to buy them when their price to earnings are the highest, and you want to sell them when their price to earnings are the lowest, which is confusing. But you want to get in on them when the cycle's at the lowest. The iron ore price is at its lowest, it's not making much money. Then you want to hold it when the commodity price runs, so the iron ore price runs, and at its peak, its price to earnings will look very cheap because it's at its super profits point of the cycle when it's making heaps of money. But that's not a sign that it's cheap. That's a sign that we're getting to the top of the cycle.
Yeah.
And so you've just got to be careful about just using price to earnings. It's a trap for a lot of new investors when they're looking at cyclical stocks.
Personally, stocks that I kind of stay out of.
Oh, I mean, I own BHP. I have no issue owning BHP.
Yeah. That's not true, actually. For me, I was definitely in the game last year with Min Resources.
Yeah.
So tried to play that. But generally, I would have a word of caution that you probably want to understand the underlying cycle quite well before trying to dabble in trying to play the cycle of some of these companies.
Yeah. I mean, like, I own Novo Nordisk. You own Novo or Eli Lilly?
Not at the moment.
Okay. Well, like, there might end up being cyclical stocks in the sense that they develop a new drug, they go well, and then they go in that development and phase 1, phase 2, phase 3 trials again. And, we've just seen the phase 1 trials of their latest drug, amoxicillin or whatever it is, which is more than twice as effective as semaglutide in phase 1 trials. And so that might end up being cyclical based on like the pharmaceutical development cycle. That's probably the main ones for me. Yeah, I don't have a heap of cyclical stocks, but I wouldn't be scared of them. It's just for me, it would be like I would only want to invest in cyclical stocks that will win through
Longer
the
term,
cycle
yeah.
and will win longer term and have some form of like long-term sustainable competitive advantage, which means they will continue growing. They will be bigger through the cycle. Yeah.
Nice. Well, thank you so much for the question, Will. As I said at the top, we love hearing from you guys. Keep the questions coming. There'll be a link in the show notes or the description below for you to ask and submit a question to Equity Mates. We're going to take a very quick break, and on the other side, we'll be chatting to Chris Judd to get his views post-US election. We'll be right back.
G'day, Bryce.
Chris, welcome back to Equity Mates.
Thank you, Bryce. Good to be back.
So last time we spoke with you, Chris, and for those that have just joined us, we encourage you to go and listen to our in-depth episode with Chris towards the end of last year. We really unpacked your views on what might happen in the US election and then how that's going to play out when it comes to positioning for your portfolio. So with that in mind, what are your general thoughts post-election? Is it sort of playing out how you've expected it to?
Yeah, some has been, and some of those things, I guess we've evolved our thinking a bit. Certainly, if my memory serves me correctly, crypto strength and a focus on crypto was something we thought would come with JD Vance's nomination as the VP, and that's proved to be true. That appears to be a bigger and bigger focus of the administration. We also thought that the US dollar was going to weaken if Trump won, because we felt his deficit spending was going to be bigger than that of Kamala's, and that's something we've probably evolved our views on a bit. And we probably were a bit nervous around inflation and commodity prices at the time when we spoke to you, and we've sort of evolved our views on that too. We think US manufacturing was a real focus of Trump pre-election. We still think it is now, but rather than that being built on the back of a weaker USD, we think that's going to be built on efficiency gains in manufacturing processes and cheap energy costs. We think that's how they're going to look to make their manufacturing competitive rather than devaluing USD, because we think getting rid of a lot of regulation and having a real pro-business mindset, we think that's going to suck in a lot of capital into the US, and it's going to be hard to see the US dollar weaken significantly against a lot of currencies in that environment.
Now, at Cerity Macro, you're investing in some of these big macro trends. So when you look at that, the US dollar has sort of remained strong. It seems to be they're sucking in capital. How are you sort of positioning your portfolio to take advantage of that?
Yeah, so things that can contribute to that, manufacturing efficiency or productivity gains, we think are interesting areas to look at. And there are some Australian companies that are doing that. We think sort of ESG restrictions, we think some of those are going to be lifted. We think that's got some important investment implications. And then there's still a lot of domestic things where, things like ageing demographic and healthcare needs, those things haven't changed. That's going to be just as big a focus going forward as it was pre-election. And locally, we see some real challenges in the Australian economy. It doesn't mean that asset prices will necessarily suffer, but we think discretionary spending in Australia is problematic at the minute. We're seeing, on a per capita basis, really soft GDP numbers. And the things that are exciting us about US, their technology prowess, their ability to innovate and sort of removing a lot of regulation. We're not seeing those things occur in Australia. So there's some nervousness about some pockets of the local economy, albeit pockets that have more of a non-discretionary component to their spend, we still think can do well in Australia because we are seeing significant population increase here.
The Aussie dollar has had a significant slide since we last spoke to you, Chris. Is that forming any view on how to position in the portfolio?
Yeah, we're still nervous about the Aussie dollar because, we think in terms of bulk commodities, we think they're going to continue to be challenged because the strength in them was spurred by China's apartment boom, and we don't think that's coming back. There's been some noise around Chinese stimulus from the government. We think that's going to increase But we think that stimulus is going to be more around increasing consumer demand and perhaps some safety nets for the consumer or the Chinese population. We don't think they're looking to, have another huge infrastructure boom because they've already got so much capacity there, and they've got spare capacity in their apartment and building market, and they've seen significant price decreases there. So in terms of the Aussie dollar, we don't think there's going to be strength in the iron ore or coal markets. Not significant strength. They might do okay. And then if we look around the world, it's not just the US where we're seeing pro-business, anti-ESG, anti-regulation policies. We're seeing them in Argentina with Milei. We're seeing them in El Salvador on a smaller scale through Bukele. And, Lulu, the Brazilian president, approval rating is at a really low level, and it's highly likely both Brazil and Chile's leaders will be replaced by pro-business, anti-ESG, anti-regulation leaders. So if you look at, and Canada is very much the same. We're seeing Trudeau walk the plank now, and Polivier, who's the most likely new leader, and I think they've got an election by October this year at the latest. You're seeing a lot of commodity-producing nations put in these pro-business, anti-regulation leaders. And in terms of commodity supply, we think that's a really strong thing. But in terms of commodity prices, we don't see a world where commodity prices rip, in a world where China isn't looking to stimulate infrastructure and apartment growth. And, a lot of our bullishness around commodities longer term was just how restrictive these ESG type policies were for commodity companies to get a new mine up and going.
So, Chris, you mentioned there that sort of anti-ESG, pro-business deregulation move around the world, the US, Brazil, Argentina, Canada. Are you forecasting that something similar might happen in the Aussie election this year?
I think so, yeah. I mean, I don't have a good read on it because I guess I have a bad habit of overestimating what I think and imparting that on everyone else. So I'm really conscious of that. But if you look around the world, that's been the really clear direction of what's occurred. And in terms of that sort of woke ideology, a few countries have gone harder than that than Australia. And cost of living here is really hurting a lot of people. And I mentioned those per capita GDP numbers. I think we're up to 7 negative quarters of per capita GDP growth in a row, which is it's a really stark fact. When you think about 8 quarters of negative GDP growth is a depression. So we think there is significant pain out there. Price pressures are obvious. Still doesn't seem to be a huge amount of focus on alleviating those pressures. We do still see a huge amount of ideology and platitudes thrown out from the current government. So, yeah, I think it's likely we'll fall in line with the rest of the world and a move towards that pro-business deregulation as people need some cost of living relief.
Well, Chris, it's pretty grim. Cost of living pressures, weak outlook for Aussie commodities, weak consumer spending. We're in a per capita recession. As we close out this conversation, can you give us a reason for optimism? Is there something in Australia that you think is looking good or as green shoots or is something we can look to as a bit of a light at the end of the tunnel?
I think what's a real mistake for investors is they think that the market is the same as the economy, and that's really not true. Think about the biggest economic crisis we had in our lifetime, which was COVID, and markets absolutely ripped. Everyone saw their house prices increase by 25%, etc. So I think investors shouldn't get confused between those two things. I think we get rate cuts in Australia and, potentially as early as February. So I think from an investment landscape, I'm relatively bullish. But that's not to be confused with the economy. I think there are some pain points ahead. And one sector, that may be fruitful for investors to look at with a weak US dollar is inbound Australian tourism. I went to Japan over Christmas and there were so many people there because the yen is just so cheap. And I think we'll start to see that impact more and more in Australia. We've seen a huge amount of Indian tourists come here. You could see, potential hotspot there for inbound tourism providers, given where our currency currently sits.
Nice. Well, a positive way to end our conversation. Thank you so much, Chris. For everyone listening, if you want to check out Cerity Macro Fund, we'll put a link in the show notes. Chris has his monthly reports where he goes into a bit more detail on where some of the big macro themes are at and the opportunities that him and the team are looking at. But Chris, thank you so much. As always, we really do appreciate your time.
Thanks, guys. Great to chat.
Well, as always, thank you so much for listening and tuning in. We really appreciate the ongoing support. If you find value in what we do, 2 favours, please fill in the community survey. There'll be a link in the show notes. It really gives us insight into who is engaging with Equity Mates, as well as what you would like more of and less of over the next 12 months or so. You'll go in the running to win $500 if you complete it in full. And secondly, if you could leave a rating and a review on your podcast app, it does really go a long way to help us get in front of new Equity Mates listeners to help them on their investing journey. But as always, Ren, great to chat stocks. We'll be back in your ears next week.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.